In this tutorial video, we will be showing you how to use the Home Affordability Calculator available at Hauseit.com. If you're not already on the calculator page itself, you can get here by going to Hauseit.com. The spelling is up at the top. And go ahead and navigate to the Calculators tab, click on Buy, and then go to the Home Affordability Calculator. While we're here, it's worth pointing out that there's a couple other calculators that you might find helpful. In particular, if you are buying in New York City, there is a buyer closing cost calculator, and if you're buying something above $1 million, there is a mansion tax calculator for you to consider. If you're financing, buying a condo or a house, the mortgage recording tax calculator might also be of interest. So going back to the Home Affordability Calculator, the ultimate purpose of the calculator is for you to figure out and triangulate your affordability range based on a number of factors, including but not limited to your income, the amount of your savings, as well as the various carrying costs associated with buying real estate. So for starters, the first thing you want to do is go ahead and just plug in an interest rate and an annual income figure. So if we say, let's move with a 5% interest rate and an annual income of 175, we're immediately going to see a maximum purchase price on the right, a maximum loan size, an estimate for your monthly mortgage payment, as well as a approximate figure for how much cash you would need in order to pull off this transaction. Now, these figures are very, very unrealistic at this point, and that's because we have not put in any sort of placeholder for the inevitable carrying costs associated with the property. If you're buying a home, you'll obviously have property taxes, and if you're buying into an apartment building, whether it's a condo or a co-op, you're going to have monthly common charges or maintenance as well. So if we are to use an example, we can actually go to a real estate search portal, and why don't we pick a random listing and let's go ahead and input that information. So we're just going to scroll down here until we see something that looks pretty good. Why don't we use this one right here? It has corner exposure, looks pretty good. So let's click on this listing and scroll down until we see down here the carrying costs. Now this is a cooperative apartment, and we know that because there is a zero figure listed for monthly taxes. Cooperative corporations actually pay property taxes on behalf of all owners, as opposed to a condominium whereby individual owners pay their own property tax bills. So by way of seeing the zero, it's a red flag or merely just an indication that you're looking at a co-op, not a condo. There's a number of benefits to buying a co-op. In New York City in particular, they're usually much less expensive than condominiums. That's primarily because there are many more co-ops than condos, so supply-demand has an impact on that. And co-ops typically do also have subletting restrictions. So despite the fact that they're less expensive, there are some downsides, including but not limited to overall subletting restrictions and the fact that there is a board approval process both when you enter into the co-op, when you buy, as well as when you try to sell. That being said, let's go ahead and take this maintenance figure of 1966 and let's put that into the monthly common charges or maintenance field. Okay, so once we've done that, you can see actually that the maximum purchase price has gone down considerably. I'll remove it just so you can see that again. We've gone from 1.46 million to around $1 million. And the reason for that is we've increased the amount of monthly housing expenses. So when you're looking at the debt to income ratio, which is the percentage of your monthly income the bank will allow you to use towards housing expenses, we've increased the amount of the housing expenses. So just by way of the simple math there, the overall purchase price has gone down quite a bit. So that's the first cut on how to do the calculator. There's also a couple other fields you may want to think about, one of which is the annual home insurance premium. When the bank is calculating the DTI, they are factoring in the reality that you are required to have homeowners insurance, especially if you're financing. So we would really want to put something in here for a home insurance premium. A conservative estimate would be $1,000 to $2,000 a month, unless you're buying something extraordinarily expensive. So if we put in $1,500, you'll see again that the maximum purchase price has gone down. Hasn't gone down by a huge amount relative to what we put here, and that's just because the annual home insurance premium is really, we're talking about $100 versus here, I mean, this is about 20 times the amount of the home insurance premium. So we would expect there to be a bigger change from this field versus this input. If you have any student loans, or if you have a car payment, anything that is a fixed, predictable, recurring liability, you would need to include that here. By this, we really don't mean, credit card payments. If you pay everything off in full, this is really referring to fixed debt. So let's say you have student loans, $150 a month. Again, and putting something here is going to lower the purchase price even further. And the debt to income ratio, it does include monthly other fixed liabilities in addition to the various housing expenses. Now, one thing important to point out for a cooperative in particular, most co-ops will have a requirement for buyers that they have a certain amount of liquid assets after closing. The terminology for this is post-closing liquidity, and the way it's calculated is essentially by adding the monthly mortgage payment to the monthly maintenance payment and adding any other fixed liabilities you have to come up with a monthly figure that is basically for housing and other fixed debt. And the co-op requires usually that you have 12 to 24 months of that figure. Let's say the mortgage payment is $4,000 a month and the maintenance, as in this example, is around $2,000 a month. So the total housing expenses are $6,000. If the co-op requires 1 year of post-closing liquidity, you'd need to have 12 times $6,000 or $72,000. If the co-op requires 24 months, you would need to have double the 72, so you'd need $144,000. The definition of liquid assets does vary by co-op, so in some cases it will really need to be cash or a liquid CD or anything that is essentially cash, and in some cases a cooperative may allow you to count some or all of your 401k towards this requirement. That being said, post-closing liquidity is a serious drain on affordability for co-ops. So even though co-ops are cheaper in most cases in the city, the fact that you need to have up to 24 months of post-closing liquidity really is a game changer, because even if you have high income, most people simply will not have the cash that is needed to pay for both the down payment, co-op buyer closing costs, which are around 2%, plus the required post-closing liquidity amount. We've put in 24 months to the calculator, and we've done this so that you can see your total cash needed for the purchase. Once you've done everything with regard to filling in all the inputs here, the first thing you want to check is how much cash do you need. So between figuring out how much you can afford based on income, you can then focus on how much you have in savings. So if you don't have, for example, if you don't have the exact amount of cash needed here, you can play around with some of the inputs to try to make it work. For example, the down payment. If you lower the down payment, you can obviously see that the total cash needed goes down as well. If you're buying a co-op, most of them do require at least 20% down. So in that case, you wouldn't really be able to go lower on this figure to lower the cash requirement. Another thing you could do is find a co-op that requires fewer months of post-closing liquidity. So if we lower this, you'll see that the cash is going to go down from over 300K to 250. So you could just find another co-op that's more flexible. The other thing you could do is you could possibly seek a gift from a family member. The rules for gifting do vary by co-op, but most of them will generally be okay with a gift as long as it's not a gift for the entire purchase price. And you would be able to check this by asking your buyer agent. They'll get in touch with the listing agent or management to confirm this, obviously before you move forward to a signed contract. In terms of other things you can look at here, it is helpful for you to, again, think about the total cash that you need for a purchase. If you're still really stretched here at the 260, gifting is not an option. Really, the only thing you can do at this point is to try to lower the carrying costs. So, let's say we convert this to a condominium and the common charges are 500 and the taxes are 500. It's gonna, rather, let's put 500 here. It's going to marginally lower the total cash that you need, and that's just because you've reduced the amount of post-closing liquidity by way of lowering the monthly carrying costs. If you're buying a co-op apartment, it's very important to think about the debt-to-income ratio as well, and that's because most co-ops will require buyers to have no more than 30% of their income every month going towards housing-related expenses and other fixed debt. So in this instance, we've actually reduced the DTI to 30%, and as you can see, it's drastically reduced our maximum purchase price. Whereas before we were closer to 1.2 million, once we've made that change to 30%, we're actually a little above 700. So we are talking about hundreds of thousands of dollars in difference in terms of affordability because of the DTI restrictions imposed by co-ops. If we go even lower to the 25% area, you can see that the maximum purchase price has literally been cut by more than half compared to what it was under our traditional scenario, whereby we're purchasing a condo or a house and we can lend as much as the bank is willing to give to us. We hope this was a helpful overview of the Hauseit Home Affordability Calculator. If you have questions, leave us a comment just below the video, and please do indicate any suggestions you may have for other topics or anything else that we can do to simplify the process and provide more information and transparency to you as you continue with your home purchase.